All right, hello everybody. This is our second rendition of Hops in a Home, and today we have a few guests. Again, I'm Dan Green with Lockstep Mortgage, and today I have my esteemed colleague, Mr. Chandler Sinclair here.
Hello, hello.
He's been with Lockstep for over 4 years now, right? Excellent loan officer, works with me closely, and outstanding cat. And today we also have Mr. Glen Babcock, who I've known for almost 20 years now, I think, almost.
That is correct.
And he's our financial planner, personal financial planner, and good friend of ours for many years, and is outstanding person and individual in the finance world. So we wanted to bring him on and have a discussion today and talk about what's happening now and what happened in the past and what's maybe coming down the pike. And also, Glenn, if you want to introduce Matt today that you have with you.
Matt Salahar, who's a member of our firm, joined in 2021, has a history in the financial services industry, working previously with BlackRock and Frank Russell. But Matt is a financial advisor on our team, helping and assisting clients meet their financial objectives.
Thanks a lot for having us here today. It's a pleasure to be at the table with you guys. So yeah, it's been a heck of a ride joining Babcock Financial so far. Just really learning about how people understand the approach to financial planning, where we can meet them, how we can help them create a vision for their future, has been a real eye-opening experience coming from the business side of asset management where I was selling to people like Glenn. Very different conversations, but it's been a heck of a ride so far.
Yeah, thanks for joining us, Matt. I appreciate it. And Mr. Glenn, can you give us a background on Babcock Financial, Northwestern Mutual, just a quick rundown of what your past experience is for us?
Absolutely. And let me reiterate Matt's comments. Fantastic to be here today with you guys. 20 years in the making. And here we are doing a podcast. It's fantastic. So 21 years ago, I started with Northwestern Mutual as a financial representative. And lo and behold, found out that people were comfortable discussing financial issues with me. And I was comfortable in providing them advice. So that was maybe the first 4 to 5 years of the career of figuring out, gosh, do I really like this? Is this something I want to do for the rest of my life? And lo and behold, it is. And it's going to be...
Here you are.
Yeah. It's pretty interesting when you're 24 and you reach the top of your corporate ladder.
Yeah, right.
It's like, wait a minute, is there something else we could do here? So anyway, fast forward, and today we now have a firm of 7 people, 3 of which I'll call offensive players, and then the balance defensive players. Mm-hmm. Pretty simple. When you think about a sports analogy, you got an offense, you've got a defense, and there's a tremendous amount of work on a daily basis to coordinate and organize everything that goes into helping a family with their finances, from simply preparing account paperwork, preparing the plan, implementing it, and that's what we do. Team of 7 folks running around helping folks with their money.
Excellent. So explain a little bit with Babcock Financial and Northwestern Mutual, how that works.
Absolutely. So Northwestern Mutual is an entity that's existed for 165 years, and it is a mutual entity. So it's not going to be in the newspapers every day. You're not going to hear about Northwestern Mutual. It's one of literally the nickname is the Quiet Company. Mm-hmm. They are an entity that is, rock solid and has been. If you look at the performance through the economic downturns that everybody knows about, the Great Depression, the financial crisis, 2001, right? March 2020, our dividend rate in that last 20-year window of time has been 8.8. It's been 5. And, it's just rock-solid performance through economic downturns.
Yeah.
So started out in Janesville, Wisconsin, transitioned to Milwaukee, Wisconsin. And the foundational principle behind Northwestern, if you look at the mission statement created in 1888, was help the client. It's not the vision to be the largest. It's the vision to be the best and to serve the client. And to this day, that's one of the foundational principles of our firm. So my firm, Babcock Financial, is, like I said, a team of 7, and we have a clientele that varies in age. Or I think right now our eldest is 97 years old, a client we attained last month in January 2022. Just brought on a 97-year-old client. Alternatively, our youngest that is actively saving money is in their teens. So,
oh, nice.
Yeah. And we actually have a case open right now where we might replace the youngest client and go to somewhere like 15, 16 years old. So obviously we range in age, demographics that we serve. But when you boil it down, we're in the small business market and we're in the household market, helping folks build their wealth and protect their wealth.
Nice. Okay. Matt, Glenn, what are, whoever wants to talk about it, what are the main products you guys usually talk to clients about? Or, what's the life of a client? What's that look like?
Yeah.
Matt, if you're, I know you're newer, but to Babcock Financial, but you've been in this industry a long time.
Well,
Tell me about that.
Absolutely. So Glenn has a nickname internally, and hopefully this isn't too confidential, Glenn. We call him Fly Under the Radar. And the reason why is because all of the good work that the team does, he's the last one to be vocal about it. That character trait is so consistent in the way that we approach clients, where just the other week, actually, Glenn and I met with people that were introduced to us. First thing out of their mouth when Glenn said, "Hey, have you guys ever met with a financial advisor or practice before?" They said, "Yeah," and they tried to get us to buy life insurance. And just immediately, Glenn and I had that implicit knowledge of, we know the exact sort of individual that you met with, right?
Yeah.
So I understand the question, right? Which products do you guys typically talk about? Here's how I'll answer that, right? First, until we know you, until we know your situation, until we know where you want to be going, we're not going to be talking about any products unless you have very specific pinpointed questions that you want to get information from.
Sure.
Our recommendations come on the basis of understanding how that $1 is going to be used and what it's being allocated for. What's the time frame? What's the purpose? What's the risk appetite? And ultimately, what is the plan for transferring future dollars to the next generation, right? We are structured as a legacy firm, meaning when Glenn eventually retires, and myself and Kyle and who knows how many other planners are in the organization at that time take it over, the intent when we're doing business today is that we're going to be helping the grandkids of the people that we're bringing on board now, right? As it relates specifically to your question, though, around products, one of the things that I love about this practice is that we do not have a proprietary investment arm at Northwestern Mutual, meaning I came from the investment side of the world, representing the world's largest asset management firms. It was very clear that if you met with an advisor or a team that had proprietary investments, those proprietary investments were coming up over and over and over and over again. What we do, because we are non-captive, because we don't even have proprietary investment products, we are completely free to choose whatever we want to be able to use to satisfy the goals of the clients.
Okay.
Generally, that means, though, going to high caliber, high quality companies, the right pedigree, because at the end of the day, it is our job as advisors to advise, right? And to make sure that any recommendations that we're making, we've evaluated all of the other opportunities and alternatives that exist, so we know that we truly are making the best recommendation. Outside of that, though, that's more the offensive positioning, to use Glenn's sports analogy. If we're trying to make a ton of wealth, right, using investment strategies, another big part of what we do from a planning standpoint is protection, right, and having defensive strategies. Because the thing is, when you're creating a vision for someone's economic life, there's going to be planned events that they're aware of or we can help them become aware of, but there's also going to be unplanned events that we might understand generally what they could be, but until they happen, it's kind of an unknown. We can do a lot to plan for the unplanned using our planning philosophy and our approach. So if there's an opportunity to be defensively positioning, protecting what is driving the wealth for that individual or for that family, we're going to absolutely do that as well.
Yeah. That makes sense. That's great. Usually I just talk to Glenn. I say, I have $100. Glenn, can you turn that into $10,000? That's all. It's as simple as that. That's all I know. And Glenn says, that's not how it works. Dan. But
I'll say I'll try my hardest, Dan.
yeah, I'll try my hardest.
I'll do my best.
But no, I mean, over the years, Glenn's gotten us into many different products that, like you say, is specific to our needs, and things that I didn't even know about. I've been in the finance world, but it's nice to have an expert on your side that knows those things, can help you out. Like with Chandler here, he's younger than I am, right? But, talking to somebody that's is obviously he's smart with investments and he knows what he's doing. What are some things you'd talk to Chandler about that maybe is, owns a home but is moving forward, maybe have a family one day? What are those things that you're talking to them about?
Yeah, it's a really great question. So first off, I would tell him keep working for Dan as long as you possibly can, right?
Oh, geez. I don't even know if I'd tell him that, to be honest.
He does like cracking that whip.
Yeah, I know.
Yeah.
Get out while you can.
So look, what I'm seeing in the younger demographic right now is a propensity to go to outside non-expert sources for ideas around what to do with arguably some of the more important decisions that you're going to make in your life, right? Those economic decisions. So when we think about the Reddit subgroup that gets everyone buying GameStop, I mean, you talk about a herd mentality that should be the Webster definition, right?
Yeah.
Absence of accurate information, vacuum. I'm just going to trust someone who I've never seen or met before, and I'm going to follow along. And it worked, right? So what I would tell someone who's young, who's just getting started, who may have all of these life things occurring in the future, is to tune out the noise, right? And we see this a lot in life where we're constantly inundated with new ideas, new shiny objects, pay attention over here, pay attention over there, and look to go with a trusted source of information, right? And this is where maybe Glen will opine a little bit upon this, but one of the first stories that Glen ever told me was when he had major back issues. He was in a position, long story short, where he thought that he was going to have to go under the knife, ends up at the 11th hour because that surgeon missed the appointment, caused quite a lot of infuriating feelings in Glen, made him get a second opinion. That second opinion not only didn't bring out the scalpel, but it saved his back.
Right.
And Glen says, that was the moment when I realized the power of intellectual capital and intellectual expertise. And when you're going with someone that is going to be making important waves in your world, they've got to be the best, right? So for someone who's 22, find those people, right? Use your networks, find those people. Don't just trust everything that you're seeing from a guru on YouTube or a subreddit thread or something like that. Truly understand how they're going to help you plan. Make sure that you have questions that are answered and you're satisfied with those answers, because at the end of the day, the lasting value is in the relationship, and that relationship has to be based on trust.
Right. Yeah, I mean, that's probably a whole nother conversation we could have, right, about the GameStop. Chandler and I talk a lot about GameStop and those things like that.
You're speaking to a GameStop bull.
Yeah, you're talking.
All right.
But the good thing that I've always liked with Glen is, we have our conservative approach with all the things we need to put in place for our family and future and education, but also I always had the play account, right?
Yes,
yeah,
you
like,
do.
what are you doing in the play account, right? So there's, you have personal things that you're gonna do, and maybe it is sometimes a YouTube guru. maybe it is a meme stock or whatever's happening.
For
but
sure. I don't think there's anything wrong with planning for the future while at the same time going hard on something that you have high conviction with.
Yeah.
So those high conviction plays, especially while you're younger, I'm kind of all for it.
Yeah.
So
Yeah, so it's interesting, right? One of the kind of basic financial tenets is just the general use of your money, right? So if money is coming in the door, generally speaking, we like to see expenses, the monthly cash flow, at about 50%, half of it, right? From there, we let you have 30% of it to go do with whatever you want to do with it. And then 20% we're going to save so that your future self can thank you.
Yeah, that makes sense.
Right? within that 30% bucket, by all means. If you want to hit it big and then take Glen and I on a nice trip someplace, let's do it.
Yeah, I love it. We'll probably talk more about that later.
Exactly.
But Glenn, what are a couple of things I know we talked about that are new that have come out, like with the 529 plan and things that people should probably know right now that's kind of important?
So this is significant, you guys. The state of Colorado is one of the most tax favored as it relates to education savings for children. So we're going to go with two groups. The first group is going to be children that were born after January 1 of 2020. For children that were born after January 1 of 2020, there's actually a matching program offered by the state of Colorado that the state will match for up to 5 years, up to $1,000 of the contribution from the family. So if the family puts in $1,000 over 5 consecutive years, the state will match up to that $1,000. That's significant. We're talking
Free
about
money.
Wow.
a
Yeah.
$5,000 investment
Yeah.
becoming worth 10 over the course of 5 years. So that's the very first significant change as it relates to education savings. Second is there's a new corporate-sponsored 529 opportunity in the state of Colorado where if a business sponsors the 529 plan, the business itself can make contributions to the employee's account on behalf of their children, and the business gets a 20% tax credit for that $2,500 contribution. That's the cap. So if the business puts $2,500 into the account on behalf of the employee, the business also gets $500 back. And it can be selective because not every employee is going to have a child that's college age. Mm-hmm. So what we're seeing our business owners do is they're implementing things like this is a gift for an employee when they have their first child or whenever a child's born. They're going to go ahead and influx some money into the education savings.
Yeah.
That person may or may not be employed with the firm when their child turns 18. But you talk
Yeah.
about a lasting impact on that family is to get that tax-advantaged education savings money going at the age of 0.
Yeah.
Yeah, huge.
That's powerful.
One thing I want to ask you, Glenn, with all the savings and different plans to prepare for college, do you feel like that's treating more of the symptoms of a greater problem where people are so encumbered in student loan debts where I believe the average is over $36,000? People graduating from undergraduate, just federal student loan debt. How do you react to that with, sure, there are new things and new programs to help save for the future, but at the rate of the student loan just crippling the next generation, it seems to me like these are things that are reactionary versus addressing the issue head on, which is it is too expensive to go to college.
Where'd you graduate from?
I went to University of Colorado at Boulder, graduated with $18,000 in student loans.
$18,000 in student loans. So I'm not going to speak, proactively, if I'm setting money aside for a client's child's education, that by definition is a proactive move to prepare them for education. Right? Now, I will tell you that some families strategically will utilize debt to get buy-in from a child. Meaning, are they thinking strategically about how they want to position their child for entry into life? Now, we work with families that have $360,000 of student debt, and that's a $3,000 per month obligation from the day the kid graduates college. That is a tremendous amount of debt to carry forward. So when I think about college expense, right? Will it normalize? That's the question. In other words, will there come a point economically where the income that I can earn from XYZ degree warrant going to University of Colorado versus starting in a community college? So some families are fighting back on this. Their children are taking courses in high school that are getting them college credits. Then they enter at a community level college, and then they go for the full 4-year degree experience. So families are addressing it in different manners, right? Now, when a child accumulates student debt, there are some steps that can be taken to help. And one of the partnerships we have is with a firm called GradFin. And what GradFin helps our clients do is they help them address that college debt through either restructuring or refinancing. And then also for those that qualify for the loan forgiveness programs available from the government is that they help them make sure that every box is checked, every T is crossed, every I is dotted. And in some of our clients' situations where they do qualify for those loan forgiveness programs, we've had clients that have been able to forgive up to $100,000 of student debt is a number that comes to mind as a maximum. But it will be interesting to see what happens, Chandler, in the future as it relates to college cost. We use a 6% inflationary projection for college. So I'll use my own personal example. Lexi, my daughter, she wants to be a vet. Now, I keep telling her mom graduated from CSU. And it happens that if you run the 8-year projection for Lex, she'll be 18 in 6 years. Her birthday is March 4th, so she'll be 18. It's $800,000 to become a veterinarian.
Holy smokes.
Okay? My son, Mac, now, Lexi's wanted to be a vet since she was 3. Mac, his most recent rendition is, I want to be an aeronautical engineer. I want to go to Embry-Riddle in Florida, and I want to eventually be an astronaut, which you look at this kid, he's the most social kid on earth.
Yeah.
And
You don't think he would do out in outer space?
He wants to be the first person on Mars. I'm like, how are you going to do it? You know, what, 450-day trip to Mars by
He'll
yourself?
be in the metaverse. He'll be
Yeah.
fine.
Yeah.
The cost on his education projected is $850,000 because he's 2 years younger. So you look at that and you go, all right, how do we address that if that in reality that does happen and both of them want to go to those schools? So for Lexi, somewhere she decided she's going to Oklahoma. Now, she's never been to Oklahoma, and I'm like, what? Oklahoma?
Where did Oklahoma come from?
Where did Oklahoma come from? Like, you're born and raised in Colorado. You've got a great veterinary school. And total side point, if you guys have never been to the CSU Spur over near
No.
the stockyards downtown, have you been?
It's
amazing.
impressive, huh?
What is that?
Awesome.
Why don't you know what that is?
So at the stockyards in downtown Denver, they're building buildings. It's a CSU extension right next door. So they're building the building that is open now is called Vita Life.
Uh-huh.
And so you can go in and you can watch live. You can watch them doing surgeries. They have a horse rehab center. They have a horse rehab pool where a horse can rehab injured body parts in a pool. And guys, we went over there. It was so cool. They had the virtual reality machines. And so you're watching a dog, and you're seeing the parts of a dog. And so you're seeing how students today are getting quizzed in college, which is different from how I got quizzed in college.
Right.
I didn't have a virtual reality machine where I had to point at things in my chemistry or biology class.
Virtual? I don't think so.
Phenomenal. Absolutely
They barely
phenomenal.
had Pong
Impressive.
back then.
Exactly. Now you're dating me. That's not fair. But I will say that
I'm in the same boat.
yeah. Apparently, Atari is responsible
Yeah.
for the people who are helping us land planes these days, and it's a true thing, is that the FAA is looking for gamers to help be the air traffic controllers.
Oh, okay.
And so
All right.
gamers are helping land planes. Who would have ever thought that the advent of Atari, where I sat there and I played Pong,
Yeah.
right? Oh my gosh, this is crazy. This is fun. In today's day and age, my kids would go to sleep playing that game.
Yeah.
Dad, you're so old.
Yeah.
You're so old.
I've heard that in the military with the drone systems and
Mm-hmm.
everything. Gamers, it's very similar. They build them similar to what they're used to with 2 hands, fingers.
Exactly.
But it's very interesting.
So-
But it's a great question. Back on college, where we're coming from.
Yeah.
I think you, Glenn, you have a tool to help people in the future with that. Obviously, the cost of college is is crazy. Like you said, will it normalize? I've got 2 kids in the same boat. You send me things that say how much college is going to be, and then I pass out, and then I don't even want to talk about it anymore usually. But I think that what happens is, like Chandler was saying, I think things will change, whether that's normalizing the cost, be going 2 years at community college, there'll be more, hopefully more trade schools that people are going to. But a question on that, let's say somebody, saves for 529 and they can use that for trade schools, community colleges. What other methods can they use? Like, let's say they don't go to college.
Mm-hmm.
What happens with that?
So, a lot of options. And first, in our written statement of philosophy, you'll notice that we encourage clients not to save more than 50% of their money in education-specific assets because of that exact situation, which is maybe we have a family with 3 kids, a family with 2 kids, a family with 4 kids.
Mm-hmm.
Well, statistically, 1 may elect not to go to college.
Yeah.
Or 2 may not.
Mm-hmm.
Who knows, right? So choices with education-specific money where the kid decides, I'm going to go do something different than a college, trade school. Right out of high school, they create Facebook, and right, or the Facebook 2.0, and they crush it, right? And here we go. We don't need college education. I've crushed it. So choice 1 is simply to change beneficiary on those assets. And little
You just move it right over to a different child?
That's right. So Mac doesn't need it. Let's give it to Lexi.
Mm-hmm.
Easy. I maintain my tax advantage. That's for the 529 only. There are other tools where that is not true. Next is I can change it to my niece and nephews if I'm the owner, or the cousin of the original beneficiary of the account. Okay? So, and I still maintain all of my tax advantages. I don't have to do anything. I can leave it in force for the kid. If at some point in time later they decide they're going to go to college, they can use that money. I could leave it in force for grandchildren. So if I ended up having, let's say, take 2 kids and now, we've got 4 grandkids, right? I could split that account amongst the 4 grandkids. And I could have, depending on the length of span in a generation, I might have 40 years of tax-free gains in that account to help with my grandkids' education. So distributions for non-education related expenses, note taxes and penalties.
Yeah.
Yep. So that's by definition, that's bad.
Mm-hmm. But you could get, after taxes and penalties, you could get that money back.
Correct. That is correct.
Whatever that might be.
Yep.
Not ideal, but.
Not ideal.
Okay.
It's not why we save the money.
Right. Okay. I like it. Obviously, we do loans, and, Glenn and I have worked a lot together over the years with different clients back and forth. And one thing I always like to talk about, and we talk about over the years, is a lot of our philosophy for financing is having a big mortgage as long as you can. Especially with rates that are low, we're down in the 3s, maybe in the 4s here now, but still historically low rates. So we talk to people about keeping some of that cash on hand and invest in it, right? Maybe you don't want to put all your money from the sale of your home into the new home. Section some of that off. Go to Glen or to Matt. Finance some of that. Invest some of that to make some interest on it. I just like to get your guys' take on that, what you think about that, what your philosophy is, and also kind of as far as down payment. Some people come to us and they're like, well, I'm just going to cash out my 401k, or I'll take a loan off my 401k for a down payment. Just like to get what you guys feel like on that, or how you feel about it.
I'm going to let you go.
Yeah, absolutely. So first off, when we're looking at someone's balance sheet or a household's balance sheet, when we look at the liability side, which is the what you owe side, we generally categorize things one of 2 ways. It is either healthy debt or it is unhealthy debt, right? Healthy debt is similar to what you just mentioned, right? Rates in the low threes, being able to back it with an asset that is in a growing real estate market, generally pretty healthy. 20% interest on a credit card debt where just making the minimum payment is only covering the interest carry forward. You're
Right.
never really going to pay this thing off. That's unhealthy debt, right? So one of the first steps that we generally take when meeting with someone is helping them understand all of the sources of debt that they have, both in terms of on their balance sheet and access to, because not only are we going to look to clean up and eliminate the unhealthy debt just to make the balance sheet healthier overall, but if there's opportunities to leverage healthy debt sources to reallocate money or to use money for, to your point earlier, going into something that's generating more interest, right? We're going to look at those opportunities within the context of an overall plan. In terms of using retirement dollars to put towards a down payment, I mean, liquidating, an outright liquidation of a 401k, although it's a big number sometimes that you're looking at and you think, why wouldn't I just tap into that? Quite frankly, it's not a very good idea, right? Because just on the heels here of our taxes and penalties conversation, right? Having to pay an IRS penalty for getting out of your 401k prior to 59.5, and then having ordinary income tax on that amount as well. Remember, income tax bracketed structure. This is being put on the top of that pile, right? So the effective rate is very, very high. The policy loans, though, or the loan on the 401k is a rather interesting one because there are quite a few plans out there that do have a provision, not only to allow for loans, generally we see this up to $50,000, sometimes more, or up to 50% of the account, but there can be provisions on the loans on the use of those monies, right? So if you're going to be pulling out the money to go buy a Tesla, the interest rate that you might pay might be slightly higher than if you designate it for a mortgage for a primary residence, right? And generally speaking, very favorable interest that very importantly is paid back to you. So essentially what you're doing is you're giving up the variability of returns of the amount that you're taking out by way of loan from your 401k, but you're locking in a guaranteed fixed rate of return, which is your interest rate that you're ultimately repaying to yourself. And generally we can see these loan programs structured out as far as 15 years. So it can be a really good way to access capital for a down payment. But again, we would be taking a look more holistically at the entire balance sheet just to make sure that all the opportunities and chances that they have to raise money are looked at.
Yeah. Yeah. Do you have some? I'm sorry, Glenn.
Oh, I've got plenty of this topic, Dan.
Well,
This is one of my favorite topics.
Yeah. I just, for perspective, I just did a video on this. And this comes from Mr. Barry Habib, who does a lot of economy for mortgage-backed securities.
He's
and
the
everything.
mortgage guru.
He is a mortgage guru, but one of the things we went to with him is like looking at it, like if you bought a $500,000 home and you put 3% down, just 3%, of course, is what, $15,000, right? Over the next 10 years, it's estimated to be 4.7% appreciation in the Denver area. So a simple way to look at it for the cash out of pocket, you only have $15,000 coming out of pocket. You're going to have to rent or you're going to have to buy, right? So you're going to have a mortgage or you have rent. So if those things are considered equal, you take your $15,000, buy your home, 4.7 appreciation over 10 years, that home's going to be worth $788,000. So that $15,000 that cost you is now you have $288,000 in equity over that 10 years. It's just making people realize the power of, sometimes it's just a simple down payment. Just can you get there to that home? You have appreciation coming. I'm not even talking about the appreciation that's happened. Last year we had 22% appreciation in Denver. That's crazy. Ridiculous. Now we're not going to have that all the time, but still conservatively over the next 10 years for 4.7% every year. That's good growth on the money, right?
That is.
What do you think about that, Glenn? I see your wheels turning.
Oh, my wheels are turning, bud. All right. So we've got to look at our client specifically and their investor risk tolerance. Okay. So question, if you own a home, what are the 3 ways to get equity out of that home? So let's use your example. You purchased a $500,000 home, It grew to $788,000. What are the 3 ways to get money out of that home for use?
You could do a cash out refinance, home equity line, or sell it.
Those are the 3 things. And that was totally unscripted, and that's verbatim what I say to a client. Okay? 3 things. 1 is I can sell the home. 2, I can take a HELOC. 3, I can do a cash out refinance. Okay?
Yeah.
There's one thing we've learned over 21 years of working with clients' money is that we get the phone call. Glenn, we need money for, and then fill in the blank. It doesn't matter whether it's college expenses, whether it's medical emergency, whether it's investment opportunity. Crypto lost 50% in value yesterday. I need to buy some crypto, right?
Yeah.
Whatever it is, just fill in the blank. We do this all the time. When you look at the ideal mortgage today under the recent tax law changes, it's going to be, your example is great of utilizing a small amount of capital in order to garner equity. So the IRS will allow us to deduct interest on a mortgage up to $750,000. So if our home value can support a $750,000 mortgage, you look at the zip code and you see what the jumbo loan rate is in that area, what's the maximum amount I can borrow on a traditional versus a jumbo. Then we look at the tax returns and we see what is the viability of deductible interest. Okay. Then you got to go to investor risk tolerance and just understand how much capital do they need. Is this a family that regularly makes large investments into things? Is this a family that hates debt, that simply says we're doing everything we can to be debt-free as soon as possible?
Dave Ramsey has a lot of followers.
Yes.
Yeah.
Okay. Now, that is a completely human feeling. I don't want to owe anybody any money anywhere, and I want to be debt-free. So then the question becomes, and we can do the financial analysis all day long. We can show them, look, 5-10 years down the road, this is the difference in your net worth. Which is more important? Is it more important to have more money in 10 years? Or is the feeling of security more important, that I don't have an ongoing obligation? So we have to weigh that out with the client. Now, from an economic perspective, leveraging Denver real estate, maybe 80% loan to value, where no mortgage insurance.
Sure.
Thank you. Appreciate the help there, the assist. I am getting older, by the way. One of my good friends says, I'll see you when we're older, when we part ways.
Yeah.
So, if I'm going 80% loan to value, no mortgage insurance, and I'm maximizing the deductibility of my interest, if you said from an economic perspective, what's the ideal mortgage? It's that one. It's that one. Now, when you reference 22% appreciation in the Denver real estate market in a 12-month window of time, first, that's higher than what we would expect average from real estate, and it's actually 3 times what we would expect. We expect average real estate returns to be 7%. So what's happened is clients have had an increase on their balance sheet of 22% as an example in their home value. So regularly when we're interviewing our clients, we're hearing there's a tremendous amount of equity in our homes. And so we're going to evaluate the balance sheet and we're going to see if there's any unhealthy debt that needs to be eliminated. And we can do that depending on the investor risk tolerance. We can do that through a cash out refinance or a home equity line of credit. Other scenarios might include taking principal to buy an investment piece of real estate or a second home or something to that effect, where the clients want to expand their footprint and they want to expand their capability to grow their net worth. We may have a situation where they want to do a cash out refinance to buy a business, right? We recently did that with one client where he was the selected successor to the long-term owner of the business, and lo and behold, the place where the money was in the home. And the cheapest source of money was the cash out refinance.
Sure.
And so that client chose to take equity from their home and buy the business, a long-term income generating asset that he can build net worth in.
Mm-hmm. Yeah.
Here's
I love it.
Here's
Yeah.
another thing to think about too,
Yeah.
right? Kind of general financial planning. You want to have 6 to 9 months of cash on hand as an emergency fund, right?
Sure.
The ability to keep the house afloat, so to speak, should income temporarily or for longer come down. If you have 6 months, let's just say $10,000 a month, 60 grand sitting in a bank account right now as your emergency fund, you're earning 0.01%.
Right.
Okay. It's a fancy term in our world called a basis point.
Right.
It's fractional of a percent. And that earning is going to be taxed at the highest tax rate possible, which is income tax. So you're effectively making nothing. And oh, by the way, now we have transient inflation of 6-7%. You're losing money.
Right.
Right? Think about it like this, right? Rather than having the money liquid in your bank today, earning nothing and not working for you, what if it was deployed into a situation whereby it's in an appreciating asset? You can set up the HELOC like we were talking about, getting access to the capital. Not saying that's a broad-based recommendation, just saying right now, the way that money is earning nothing in the bank means that if we can overcome the psychological hurdle of not putting cash literally or figuratively under the mattress and rather deploying that capital to work, we can create all sorts of opportunities for growth and financial goal attainment that historically, 15 years ago when your money was earning 5% in the bank, you could feel pretty good about that return.
Right.
We don't have those opportunities anymore.
Sure. Yeah. Well, and going back to it, it's kind of presenting to the client. You're giving them those options. If they want to expand their real estate empire, they want to pay off the debt. And it all comes down, just like we are, it comes down to what they're comfortable with. Do they not want a loan? Do they want it paid off? It comes down to what they want, right?
That is correct.
There's a lot of ways you can take it.
Let me just add my 2 cents here because I've been a customer with Northwestern Mutual. I've been working with Kyle, a member of Glen's team, for a few years now, and he always laughs when I ask him, "Hey, how are the markets doing?" He's like, we look at it way more dynamically than just, hey, how are the markets doing? You don't look at just the S&P 500 just to see how it's going, and that's been a really neat way for me just working with you guys and actually seeing it and experiencing what it's like to work with you guys. Is it goes up and down, but you guys have such a unique way of putting people in different products that it hedges them when the market's up and when the market's down. So I just wanted to throw that out there and just say,
it's
I
for
love the way you guys are, look at the markets.
There's no knee-jerk reaction. It's long haul. It makes you comfortable, right? You're like a warm blanket, Glenn.
Dan, I have to tell you, the day that I knew that I'd made it in my career was the day that I got a Lockstep Mortgage Yeti.
Oh, man, that's beautiful.
I knew that I had done something well for one or many of your clients through introduction.
Oh, man.
And I tell you, I appreciate you and your team and the effort that you guys have put in on behalf of our clients and our colleagues and the people that we introduce to your firm. Yeah. Because it's funny, I was talking to an electrician who's doing some work in our home, and he was just chatting me up about what I do, right?
Mm-hmm.
And we're talking, and I was telling him, I work in this industry, and then I have my crew, my team that I bring to the table when there's a need for external professionals. And we call it our professional advocate group. And it was funny because I said, well, these are people that I've worked with, many of them for 21 years. And I know when I bring them in the room, the work is being done is rock solid. It's absolutely rock solid. And I have no concerns over the professionalism of that crew and what they're going to be doing for my client. I said in the second part of that, is when that client or prospective client calls me and they're griping and complaining about my professional advocate. Well, I know something's up. Because I know this team and I know the work that they do.
Was there somebody complaining? Do you have a live example? No. Okay, good.
No.
Okay,
Good.
you scared me. I didn't know where you're going with that
Oh,
one.
no.
Here's what I'd love to talk about is I put it on our sheet, kind of discussion, and Chandler can help with this too. Is just how are you guys marketing to the younger generation? We started off in the front, Matt. You're talking about whether everybody can look at things on YouTube, and it's a different world, and tech is different, and different things are coming down the pipe. How do you market to those individuals, or what's your strategy to kind of keep their attention?
Yeah, absolutely. So what I would say is what really makes us different is that the word of mouth based on experience is what we lean into heavily for our marketing efforts, right? I think that if you're out there chest thumping, particularly me with less than 1 year length of service here, pounding my chest around all the amazing things about Babcock Financial, how much weight does that carry relative to someone who's been a client of the practice, for example, for more than 2 decades, or a professional advocate who understands the scope of the work that we do because they understand how we fit into the scope of work that they do, right? So in a day and age when everything is going digital and you're looking to Google for answers and you don't know what to trust necessarily, we're finding a unique path of not circumventing that, because stuff's all really, really important to have a presence, but leading with the trusted relationships to get introduced to the sort of people that we know that we can help, right? That is ultimately how we're choosing to market our practice. It's not to say that it's the only way to skin a cat, right? But when we think about the sort of business that we want to be developing, that drives the marketing strategy. The marketing strategy is saying, okay, the business that we want is basically what we have today multiplied, right? Multiples of this. We have the infrastructure, we have the team, we have the processes, we have everything required to help more families. So what's the easiest way to meet those families? Try to explain everything about what we do, which would take 2 years, or ask the people that know and value what we do who they care about and whether or not we could have a cup of coffee with that individual.
Very good. Chandler, what do you think about it? With you, what's your perspective on finance and where things are and what connects with you?
You know what's funny is the most successful conversions I have are when I meet with people in person. So I think no matter how digital we get, and even if it's doing a shared screen, it's just still having the face-to-face, even if that is, over Zoom, and going through everything, building trust, and just making sure people feel confident in a big decision that they're doing. Mortgage debt, that's going to be the biggest debt that they take on, and they want to know that it's being executed perfectly and that they feel really confident in their decision. So honestly, even my younger generation, it's still about face-to-face.
Yeah, that's interesting. Kind of wouldn't expect that, these days. But where do you guys see with things coming along with crypto and NFTs and the blockchain and everything that's involved with that? How do you see that affecting the finance world?
All right.
You got some of this?
Can I use your Yeti cup as an example?
Yeah.
40 years ago, did you ever... Shoot, I just dated myself. 30 years ago.
We'll edit that.
Yeah. Cut that. Strike that.
Did you ever buy a cup that you could register the product online and have a registered Yeti cup 30 years ago?
No.
No. No. Economics has changed. Marketing has changed. Dan, ingenious marketing, right? I sit down at my table in the morning. What do I see? Lockstep mortgage. That's a well-spent dollar you put down on that cup right there, because it reminds me of my buddy and my professional advocate when I have my first interview of the morning. Okay? So you ask me about crypto and NFT, and I tell you for 21 years I've been doing this, and there's been the latest, greatest whiz-bang thing that has been created, right? when you boil it down, and specifically you go to crypto. Crypto is a non-regulated asset. I actually know of an individual who recreated a crypto chain, created $48 million, sold it, and retired.
Nice.
Okay, so
Good for them.
congratulations to him. Genius. Now, that said, from an overall economic perspective for the rest of us that don't have that skill set to recreate that, and that's not an option, in putting money in a non-regulated asset, there is risk associated with that. So you see the crypto values, they vary widely, right? So crypto is a new asset class, is effectively what it boils down to. And so if you go back in time, right, we've got the gold standard. If you look at gold and silver, highly volatile asset. Crypto, highly volatile asset. Does it fit in the plan is the question for the specific client. And if the specific client can take that volatility of an asset, then it's a great asset for them to own. Okay? But if they can't take the volatility, then they shouldn't own it. Okay? That's all at an individual level. Okay? So there will be regulation in the future, in all probability, around crypto. And that is an asset class that we as a firm continue to monitor for our clients as part of their overall plan. So when we run the plan and they own crypto, right, we plug it in. We show what's the objective with the crypto. Well, the crypto, the idea is we want to use that as a retirement asset. Okay, and then how will it be utilized as a retirement asset? Will it be liquidated, income stream? What's the use of it? Okay, where does it fit in the overall picture? And that is what has to be understood about each individual asset in the family's plan. Now, what's happening is, I'm going to use the word optionality, okay? The Yeti Cup is a fantastic example of optionality in the development of our service industry, our product industry over the last 30 years. And quite frankly, optionality can create paralysis. There's too many options. There's too much information. People get to a point where they get into overload, and literally you study this process, the brain shuts down. I have too many options of what I can do with buying a Yeti cup, or I have too many options of what I can do with this dollar that I want to invest. Okay, one of our real expertises and one of our differentiators is that we boil it down and we say, this is our recommendation for this $1 that you want to invest, or for this $5 or 10 or whatever that number is. As long as it relates to the client's objectives and their long-term plan, we're going to make a specific recommendation around that dollar. And we, as a firm, have, if you allow me to use the phrase, sifted and winnowed through those choices. And now we're going to make a specific recommendation around which Yeti cup to buy. Right. Get the gray one that says Lockstep Mortgage on it.
I like it.
Because I'm going to tell you what our clients appreciate about your firm and about you guys is the information that they receive through the underwriting process that you provide is a differentiator. A lot of our clients oftentimes, and we had a client at one point in time who was underwriting a commercial mortgage through one of the widely known banks. 3 days before closing, he got a list of 32 requirements. Needless to say,
don't think it closed, did it?
Actually, we created the money for him through a line of credit in our organization.
Going above and beyond there.
And he was able to close on the scheduled closing date. And the day that he bought that piece of real estate, he walked into a tremendous amount of equity. So that was a good story around our ability to create lending for clients. But that's a specialized thing that we do. But back to my point, our clients appreciate the way you guys share information through the underwriting process, because they don't end up with that, last minute surprise. Oh gosh, we need X.
Right.
And that's the regular feedback that we get when we interview our clients when they're done interacting with your business, is that the communications and the expectations are set and they are crystal clear. And that's one of our internal values in our organization is crystal clear communication in order to properly set expectations.
Yeah. I like that. We might have to steal some of that. It's basically what we do. It's not written out. I mean, we try to be experts up front, get everything gathered, know what we need.
For sure. And
We don't like
even
surprises.
when there's a problem, it's so much better to make that difficult phone call early. Say, hey, you know what? Here's something that we need to address.
Yeah.
And we have weeks to work on it. You
Yeah,
know what I
right,
mean?
right.
Instead
We
of,
have
hey,
time.
it's 3 days.
About your closing tomorrow.
Right.
We don't like that.
No.
Hey, Dan, just one
Yes,
point on
Matt.
your crypto
Yeah.
NFT
Yeah.
question. So, in terms of communicating clearly, I feel like there's a lot of misunderstanding out there as it relates to the returns of cryptocurrencies. We know that there's a lot of velocity in the market, up and down, right? If you follow it at all, you know that. One of the lesser known kind of basic tenets of money management is how percentages work on returns, right? So a really simple example would be to say, Dan, I'm going to give you $100 and you're going to go buy Bitcoin. And unfortunately, Dan, I did this right around Thanksgiving, so you've now lost half of it. You're at
Right.
$50 of cryptocurrency. I say, well, yeah, told you it was a scratch-off lottery ticket. We're down 50%. And you say, okay, no worries. I'm just going to make 50% and I'm going to get my money back. It's a big misconception, right? You've gone from $100 down to $50, 50% loss. You need to double that remaining 50. You need a 100% positive return to offset a negative 50% decline.
Right.
So when we think about what's likely to happen in cryptocurrencies in markets with massive gyrations up and down, is that you're going to have a lot of people feeling really, really good when times are getting good, really, really bad when they're not, and then wondering why they're not getting back to a point of recovery when the amount of gain that they're seeing on a percentage basis meets or exceeds the downdraft that they had, and they're wondering why they're not whole yet. So just
Yeah.
wanted to
Yeah, it
put a
makes
fine
sense.
point on that risk.
Definitely. So one thing I did want to talk about why we are all here, because I think Glen is an excellent salesperson. So for those of us listening that might be other sales associates or people in our industry, your industry, I think Glen has been outstanding over the years in his approach, the way he does things. His referral system has always been excellent, the way you ask for referrals. It's not easy for a salesperson to ask for referrals, right? It's the toughest thing. I tell Chandler, and Alexis is new. I was like, okay, do as I say, not as I do, because I don't do it that well. But just if you could give me a little breakdown of your approach to sales and asking for referrals, or what's your perspective on that?
All right. This is a big one, Dan,
All right.
because
Okay.
you're talking about the future success of the younger generation.
Yes.
Okay. And there's some core philosophies, some core beliefs that you have to have. So you may have experienced some of this yourself. If I'm talking to Chandler, and Chandler is a prospective client, and Chandler says, right now is not a good time to meet because, and just fill in the because. There's 1,000 reasons why a prospective client can't meet. And I don't care if you're selling widgets, mortgages, financial instruments, just fill in whatever you're selling, right? So, Chandler, how long is it going to take to resolve that issue? Well, it's going to be 3 months. Okay, well, today's February 22nd. I'm going to put a note out to give you a call on May 22nd. That's going to be 3 months. Okay? When I call him on May 22nd, now I make sure May 22nd is a business day because I'm not calling him on Saturday or something,
Yeah.
right?
Right.
But when I look at my calendar and I put that note out there to give Chandler a call, I call him and I remind him, hey, Chandler, it's Glen. Wanted to catch up with you. It's May 22nd. I told you I'd give you a buzz today just to check in and see if the issue, fill in the blank, has been resolved and if now is a better time to meet. That's a client-centric approach, and that's the phrase that I use. It's a client-centric approach. Whatever objection he has is a legitimate objection. It's not one that we're going to try to skirt around just to get a meeting so he and I can get a coffee and shoot the breeze. I need to legitimately understand that he's in the mindset that his mind is clear and focused on the issues we're going to talk about. And again, if I'm selling cardboard packaging, I want to know the issues that are going on in the company's buying agent's mind in terms of the hurdles to overcome to take them from prospective client to client. And I want their mind 100% focused on the topics that we're addressing that day. So giving him that time and that space, but then reminding him, I told you I'd call you on May 22nd. It's May 22nd, and here we are. We're chatting, or I'm leaving you a voicemail at least to remind you of that.
Right.
What happens in Chandler's mind is he goes, this is a guy who does what he says he's going to do. And when you do that repeatedly for multiple decades, then there's a trustworthiness factor that comes into play. Okay, so that's part one. Part two is a bigger issue because, again, if you get back to the optionality discussion, salespeople are given so much behavior to track. And I've watched, and again, mortgage people, financial professionals, I've watched for 2 decades as the organizations get all abuzz about the new recruit who's coming in. And the reason they're all abuzz is because of whatever factor. They've got this huge network or whatever. And it all comes down to the fact, if a person is willing to commit on a daily basis, and I always tell them when I'm talking to the younger generation, figure out one thing that will make a difference every day and do that for a year. And if you do that, I promise you the momentum from that year will build the next year. Now, next year, that one thing you do every day, it might be something entirely different than you did for that year, because now your business, and every salesperson should look at their organization as a business. It's their business. Chandler, you have a business inside a Lockstep Mortgage. You have a pipeline. And as you build that pipeline and more of that closes, and the higher percentage and the higher your skill set gets, then you become more important to Dan's overall organization. But every salesperson should come to work every day with that in mind. And they need to know that one thing, because of the optionality of things to chase and track. If you commit to that one thing, and it's got to be something that they're in control of, it cannot be the whims or the emotions created by whether or not XYZ client or prospect said yes to your most recent proposal. It has to be something that person is in control of. And whatever industry it is, that's different, right? You might be in the B2B market, in a business-to-business sales market, where you've got to knock on 15 doors a day and shake hands with the purchasing manager of right. 20 or 15 mid-sized manufacturers, right? But in our business, for one entire year, every day, I picked up the phone and I asked 30 people to have an appointment with me. And that was tough to do. It was one day, every business day for a year. And I look back on that year, and that was the year that catapulted our business. It was the year that we went from, we're doing well, to, now we're growing 20+% per year. And it was that year that I committed to that, and I did that. That made all the difference, and that was, I think, 14 years ago.
Yeah.
So
one full 100% commitment to one habit.
One habit that you're in control of will change your trajectory.
That generates business, or hopefully generates business. Right?
Correct. Yeah. Sitting around reading the internet.
Yeah.
Let's see what's
2 hours a day.
2 hours a day.
study my craft on the internet.
I'm going to go to the local coffee shop and have a latte. Yes, one activity that's vital to the success of your business every day that you're in control of. So you can go home at the end of the day and you can say, I did this or I didn't do it. So it's got to be quantifiable. It's got to be measurable. You had John Crisbins in here last week, so I know you talked about this stuff.
Right.
You got to have a scoreboard.
Yeah.
I mean, why do people love to watch sports? The gratification, right?
Yeah.
And the information and the knowledge of how their team is doing is instantaneous because there's a scoreboard. So we as a business owner, whether you're selling widgets or mortgages or financial instruments or whatever you're selling, books, you got to have a scoreboard to know how you're progressing towards your overall larger objective.
Mm-hmm.
And that's
it gives
a
you
differentiator.
accountability for sure.
Accountability. Yeah. And then John would tell you, and you could probably replay it from your last time, that scoreboard has to be public. People have to be able to see it and ask you about it.
Yeah. Yep. That's exactly right. Yeah. And one habit also that you have, I don't know how much when you were newer to the business back 20 years ago, you had a habit of asking for referrals a specific way each time you met with someone, right? Explain that. I think that's pretty powerful too. If that's somebody's habit, that would help as well.
This goes beyond just asking for referrals, right? As a professional, when we interact with clients have a gut instinct and they smell commission breath. Okay? Have you heard that phrase? I love that phrase.
I have not, but I love it.
Okay. If you're in need of the income of the client or prospect that's sitting in front of you, you're in trouble. You're in big trouble because that person can sense that the business you're proposing to them is about you and not about them.
Right.
And that is a dangerous position to be in when you're a sales professional. And again, I don't care if you're selling financial instruments, books, cardboard, whatever it is, tables. So the repetition and the practice of each component of your process creates confidence in how you deliver it. It's a differentiator when you go out in the marketplace and you've dealt with enough professionals in your time that you know this, is that the one who's hemming and hawing and I'm not certain, but Dan, let me get back to you. You can only do that so many times. You can only go to that well so many times of, I don't know, but I'll get back to you with the answer. There comes a point where through the repetition of your process, the confidence becomes so clear to the client or prospect that they know the solution's already been vetted. The answer is X. You should buy 3/4-inch corrugated cardboard because it's going to provide the safest shipping for your widget that you're working with your client in California. And by the way, we have a stock and supply of it, so we'll have the cardboard to you on Tuesday. And lo and behold, boom, there it is.
Right.
Everything's there on Tuesday, and the product is delivered in a timely fashion. So that consistent manner in which we ask for introductions, and there's a mind shift there, Dan, is that clients who continually refer us, they know who we want to meet, and they put us in front of the people that we want to meet. And that repetitive process is one that, from a business perspective, the introducer, the person who's going to introduce us to a prospective client, they're comfortable. They're in control of that. And they can say, yes, oh gosh, I know Dan Green, and I think you and Dan Green would hit it off. I think you would have a personality match. And by the way, Dan owns a mortgage company. He has a team of 7 people, and he has a family he cares about. Well, that's the ideal person that I want to meet and I want to know.
Right.
Because that's the person that I can help the most through our process.
Mm-hmm.
So when you look at repetitive process in business, it's not sexy. It's not exciting. It's not overwhelming.
Sell yourself short, Glenn. This is all sexy.
Exactly. But what it does is it gives people comfort
Yeah.
and confidence that the professional that they're putting in front of their mother,
Mm-hmm.
their father, their brother,
Yeah.
their child, right? I'll tell you, one of my favorite things to this day to do is to get a 22-year-old enrolled in their employer-sponsored 401k plan,
Mm-hmm.
because we get them setting 5% in and then establishing that habit, right? Money is habitual.
Right.
So they start setting aside 5% of their income and their employer is matching 4%. That particular transaction, we make $0 off of, but I know that that person now has a lifelong habit that will put them in a place 45 years from now, frankly, unless I'm the anomaly, I'm going to be dead. Okay? Maybe. I hope not, actually.
Consciousness
I'm
will be in the
still-
clouds
You want-
somewhere.
you
It's
want-
still a possibility.
You won't have to do much forecasting at that point, though, Glenn.
That's
So-
true. But I know that lifelong habit that I've just helped that person establish, or Matt or Kyle has helped that person establish, is going to change. And you can call me crazy, call me what you want, but I know putting that person in good financial footing in their early 20s, helping them resolve their student debt, helping them establish retirement savings.
Right.
Lo and behold, if you look at the studies, that person is going to be in better financial footing than if they didn't meet that advisor when they get married, when they have their first child, when they buy their first home. All those things, the foundational work that we do with 22-year-old college graduates makes a difference in the trajectory of their life. And I think that's a really cool impact, you guys. I do. One of my favorite things to do, Dan, and I tell clients and prospective clients this, is that we ship quite a bit of tuition money, and that happens most every February and August, off to the universities around this country and sometimes internationally, depending on the student and where they choose to go to school. I love those 2 months. I love sending money to universities and helping the children of our clients get to that next level of education. That, to me, is something that is impactful. So,
Very good.
And when they
Matt?
come out of school and they find themselves being the 22-year-old themselves in sales, just to go back to the referral thing, one thing that I wish someone would have told me day one of selling, because we know prospecting is the lifeblood of any sales profession, right? It is not your client's job to prospect for you, meaning you do not put the onus and the control on them to do the work that you should be doing.
Right.
So very specifically, when I'm asking for introductions now, say, look, you understand the scope of the work that we're doing. I really only have one litmus test. Could you sit down and have a cup of coffee with this person? Because at the end of the day, what you're selling truly doesn't matter if you want to do it for the long term. Doesn't matter that you're selling mortgages and we're selling financial plans. Product is irrelevant. It's the relationship that is relevant, right?
Sure.
So one of the hardest things, I think, for a 22-year-old who's out there ready to make hay in the world is to have the humility to know that you need to play the long game, and that the investments that you're making today, the seeds that you're planting today, will become saplings. Requires so much care, so much attention. Eventually, by the time you're in Glen's situation, they're oak trees that you don't have to fertilize and water every single day, and now they're dropping their own acorns, right? So for a young person just starting out looking for referrals, be very, very careful about saying, go tell X, Y, and Z what I do and why they should meet, and be more direct around getting exposure to the sort of people that you would want to be working with for the long term.
Yeah, that totally makes sense.
Yeah, just my 2 cents here. I'm 26 and I look even younger. And one thing when I was first starting out that was difficult was, do I really trust this big financial commitment, this mortgage with this guy who looks so young? And basically you have to master your craft. You have to really exude confidence no matter how old you are, no matter what you look like. If you know what you are delivering and you're confident in that execution, people will trust you. So
Yeah.
I'd say know what you are selling inside and out.
Yep.
Agreed.
Great point. Very good, guys. Last thing I want to talk about, unless anybody has any other thing, this might get us off the rails a little bit, but let's go back to our first conversation.
Yeah.
Like, where do we think the market is at this point? And, like, what's happening? There's a lot going out there. There's inflation. There's war. We do have the meme stocks. I mean, Chandler and I, we talk a lot about this, right? We have our play account, and we'll mess with GME is a big one that we'll look at and we talk about and try to find the science behind it, which some of it's pretty alarming, to be honest. I mean, what do you guys think in the current market? Glenn, we've talked a little bit about this, but I'd just like to see what you think with everything that's going on.
I knew you were going to try to suck me into this
Yeah,
discussion.
come on, Glenn.
And you know I'm not going down.
You
this
know I love
wormhole.
this. You know I love this.
Oh yeah, we're
You
gonna
left
go,
your tinfoil at
Okay,
home or what?
all right, Matt.
We're going head to head. All right. So I started in this business in 2001. Late 2000, and I did not have a lot of assets under management in 2001 because I literally just started my practice.
Right.
Reference a horrible time frame in the history of our country. September 11, 2001 was the final catalyst to drive us into a recession. And markets dropped significantly, and they stayed lower for a period of years. Okay. We came out of that, and lo and behold, 2008, we have the financial crisis. And the financial crisis happens, and markets drop through 2008 by 40-some%. Okay? Since 2008, fast forward, there has been double-digit downturns 17 times. Okay.
Right.
This is the 18th, the one that we're experiencing right now. Now, my question in return to you is, how many times has the market multiplied since 2001 to today? And I'm going to preface that with the fact that every day that I pick up the newspaper or I turn on the TV, instantaneously, there is information about this stock is up, that stock is down. There's a guy saying, you should buy this stock because of this, or you should buy that stock because of that, or you should sell this because of this. Right? How many times has the market multiplied?
5.
All right.
What is it?
I have no idea. Now, here's the thing. If you invested $1 in 2001 and you had continued to dollar cost average it through the market over that window of time, right? So you invest $1 every month,
Sure.
every month. One of the greatest instructors of financial advisors is a gentleman named Nick Murray. Nick Murray counseled me many times when I was younger on the fact that the permanent performance of the investment markets is upward. In any one microcosm of time, we will experience volatility. The funny thing is, and I love the media for this, they only use the word volatility when it drops 40% in value. They don't use the word volatility when it rises 40% in value. That's just what should happen.
Right.
So, you asked me about the current status of the market and what's going to happen. There are 3 viable choices.
Go ahead.
It will go up today, it will go down, or it will stay level.
Right.
Those are the 3 choices. And I'm going to tell you that it depends on the objective of the dollar you're investing as to where it should be placed. And I am saying that with all sincerity.
Yeah.
Because I have day traders as clients. We are the stable, long-term advising arm. They are looking to make income from trading stocks on a day-to-day and sometimes hourly or minutely basis. That is a different mindset than we have. Now, you ask me, what's the status of the market? What will it be when I retire? And I will guarantee you that if you and Kara statistically live a 30 to 35-year retirement, which with your health, you and or she will live 35 years through retirement, there's one thing I'm going to guarantee you you're going to need, and it's income. Okay?
Right.
So a properly structured financial plan ensures that the clients have the income they need for the objective they're addressing. And so college education is very commonly a spike in need for money, right? Chandler, when you went off to college, there was a spike in need for money in that year. And whether it came from savings, loans, or a combination thereof, that money was had. When you hit retirement, every time a client retires, they spend the most money in the first 10 years. And that's because they're the youngest and the healthiest that they'll ever be at that moment in time. And inevitably, that's a high-stress situation because they feel we're overspending. And we've dealt with that time and time and time again. Now, what does it mean to you as an investor who's saving for retirement that I'm telling you, ignore the short-term volatility of the market? And volatility by definition is not negative, it's not positive, it's factual.
Right.
It is up or it is down. The question is how you behave. So a properly structured financial plan, and I will tell you the greatest example of this is March of 2020. You could
Right.
not paint out a better example from a financial market. Now, let's take a moment and comment on the pandemic. Absolutely horrible events have happened
Right.
as a result of the pandemic. When you look at it in the market and you go to March of 2020 and you see a rapid, significant decline
Right.
in the value of clients' investment accounts. Number one, when they call, we've dealt with this before.
Yeah.
Never this extreme. We have dealt with this before. Let's evaluate your situation and let's see what the opportunity is. Every day for 21 years, there's been a reason to sell all of the investment positions because this particular publication says that this catastrophe is going to happen.
Right.
And yet here we are 21 years later, and that dollar that I invested, interestingly enough, when I was 15 years old, I opened my first Roth IRA. I went
15?
down 15. I was mowing grass for Jim's lawn service in Chesterton, Indiana. And Jim paid pretty well. He was a good guy for a 15-year-old. And so I went down to Centier Bank. It was at the Y in the road in Chesterton, Indiana. And I opened up a little Roth IRA. with Cintier Bank, and lo and behold, fast forward 31 years later, one of the best financial instruments I own.
Yeah.
This is a Roth IRA that I opened
Right.
31 years ago with money I was making
Mowing
from
yards.
Jim's lawn service. Unreal. So, yeah, that's a long-winded answer to your question, Dan.
Well, and why I fish you in like that, I do this every time.
I know.
We have this conversation.
I know.
But why I do that, because it's a relief. It's comforting. That's why, that's why we have our investments with you. It's for the long haul. It's not short knee-jerk reaction. It's the long haul. There's going to be return. It's a comfort. And when you have that response, that makes people comfortable. They know it's a long-term investment. Relax. Things will be okay. And people need to hear that, right? You need to have a steady, source where you have your funds and you can keep it on this trajectory up over so many years. There's going to be downs, but overall it's going to be up. Same thing kind of with real estate, same type of thing. You might have a blips in the road where values can go down, but over the long haul, there's going to be appreciation. So people need that. That's the side that you need. Obviously there's a side we talk about with play money and things that we're talking about. It's kind of a joke, but I actually want people to hear what you just talked about.
Yeah.
I mean, it's good for people to hear. So I appreciate that. Now the other side of it, the fun side, right? You've got your long-term, but these short-term things that are happening, there's, like we talked with inflation and things like that. Matt, what do you kind of feel, or what are your thoughts out there when you look at what's happening?
One of the more interesting things that I've noticed in my tenure with the practice is there's one part of a financial planning discussion where the team has already gotten the information, worked hard to design the case, to understand the opportunities, and we're now presenting. It's something called the Rule of 72. And basically, back of the envelope math, if you get a 7% average annual rate of return, which generally is what markets have delivered since there have been markets, it effectively means that your money is going to double every 10 years. Okay?
Yeah.
So picture this, right? You've got a 30-year-old that comes in, they've saved well, they have $50,000 today in their 401k.
Yeah.
But they've left their company and they want to know what to do with it. It's generally how it starts, right? Okay, well, what is that money going to look like in the future? Because you have to remember, if someone's not in this business or understanding and living and breathing financial planning and creating vision for intangible things down the future, $50,000 doesn't really mean much to them other than they can go buy cash for a Model 3 from Tesla if they wanted to, right? Rule of 72, you're at 50, at 30, we get you appropriately invested. By the time you're 40, it's 100. By the time you're 50, it's 200. By the time you're 60, right, it's 400. That becomes more understandable. That becomes something that they can have a vision for. And to Glen's point, right, you look at any day, any time period, the shorter you shrink the time period, the more velocity you're going to seem to have, or more volatility you're going to seem to have. The longer you stretch it out, the more that trend line emerges, right? And just continues to go up and up and up. So what I think the real power of what we do, what Glen has done for more than 2 decades, is help people understand, based on the behaviors that they can take today, by tuning out the noise and by focusing on the utilization of the money that they've worked so hard to earn, and helping them see what that's going to be in the future.
Sure.
It's just one way to help them turn off the news that's being driven on emotion, right? It's kind of interesting. I think that if you're a good financial planner, if you're a good professional, if you're really good at your craft, emotion shouldn't be part of it. Understanding the emotion of the person that you're speaking with should be, but your delivery should be void of it. They're not paying you to double down on any sort of fear or exuberance they have. Sure, you're going to celebrate with them, right? But it's more about just making sure that you're delivering the information that they need to hear in order to make really informed decisions.
Right. Very good. Confidence, stability. Excellent. I appreciate that, guys. anything else you want to talk about today, Chandler? Any questions or anything?
I did have one question with your background and with BlackRock.
Yeah.
So you hear about hedge funds buying up single-family homes, and in January there were 129 active single-family homes listed for sale in Denver County. That's nuts.
Crazy.
Do you think that BlackRock truly is buying up all of these properties and making it, that they are the driving force behind a lot of the increases in home values?
It's an interesting question. So, first off, BlackRock is the world's largest asset manager, managing literally trillions and trillions of dollars of wealth, which means anytime they get into a market, there's a big wake that kind of follows them, right? What I will tell you, though, is BlackRock is not a hedge fund, just an asset management company, so they're going to have all of the investment subtypes, including hedge funds, right? And hedge funds is a space that is really, really interesting, but it basically just means that you're taking some sort of bet contra to what is very, very commonplace, or you're doing things to hedge out certain risks. They all get lumped in together in kind of one shell, and in reality, you've got some that are trying to make multiples of return with leverage on the markets, others that are trying to hedge out specific risk. Back to your original question, though, what's driving that? I don't know. I mean, I wouldn't say that it's the asset management firms that are allocating dollars to investments necessarily driving it. I do think that as it relates to real estate, for example, I'm not a native like most people here, I think, right? I've only been here since 2017. But the number of people, I just had a phone call with a friend of this last night. Matt, I'm thinking about now finally moving to Colorado. Where should I go? Okay.
One of the worst times.
One of the worst times, right? And it's funny, I had heard recently 270 was a home quota, but that was about a month ago. So I told them, I said, look, you've got X number of people moving in. You've got this many number of homes. You take a look at listing prices, you are not going to be paying that listing price, my friend.
Right. That's when the bidding war begins.
Yeah.
So if you think about it from the standpoint of an investment firm, right? An investment firm either trying to manage risk or generate returns. Well, the cheap cost of capital right now, particularly for an institutional investor to be able to lever up and then make investments into real assets that have return potential, like we were talking about earlier on the podcast, right? I mean, you look at any institutional investor with a forecasted rate of return of 4.7%, I think it was that you said, Dan, for the Denver market going forward the next decade, and you can borrow at prime or right around there. That's a pretty palatable way to buffer up your balance sheet, right? So, yeah, I think it's investors all around. But for this market, you guys would know better than I do. I only know from personal experience. It's like, man, everyone's trying to get, well, the getting's good. And then living in Colorado is pretty good, right? So.
Gotcha. Yeah, I did find it interesting how Zillow in Florida, they completely got out of the market of buying homes because it was so unprofitable for them.
I saw that. I actually had a friend, some of them were meeting with on Friday, actually. They just moved from North Carolina. And when they were going to list their home, because they were moving to Highlands Ranch, they needed to sell very quickly to have a really attractive offer on the property in Highlands Ranch. So they ended up going out and brokering. It was Zillow and a couple of the other robo-lenders, I guess you might call them. And the Zillow offer was something like 12% higher than the other ones. And he sat there and he looked at it and he said, well, why would I not take this one, right? Are you sure, person at Zillow, that this is what you'll offer for me? Lo and behold, yes, they sign, they get the money. And then all of a sudden you start hearing about Zillow not doing this anymore.
Yeah.
And the funny part is that my friend, he's a financial director for a really, really big corporation. And he said that he was looking at the economics of what they were doing and it was just totally non-viable. So he knew that the program wouldn't keep existing,
Right.
but he took it while he could get it.
Right.
Yeah,
You know?
yeah. Yeah, there's been a lot of that in the news where they've pulled back that program. It's almost, it's escalated the market just by their buying because they're buying over a certain percentage of what the home was valued at. It's interesting.
So really quick too, Chandler, you actually make a really good point just around the institutional investors. And ties directly back to that last conversation. What's going on in the market? What should we be thinking about inflation? Name your risk, right? There's always going to be a risk. Well, what are the institutional investors doing? Are they just putting money in the bank, earning 0.01%, waiting for the right opportunity? Absolutely not. They're allocating their dollars. They're investing their dollars. They're angling for the greatest risk-adjusted return for the use of that dollar that they possibly can. They're doing that broad-based. We just help families do that at the personal level.
Right. Very good, guys. I appreciate it today.
Thank
Glen, Matt, thank you for coming in. Chandler, I appreciate it, buddy. So thanks. I'd love to do this again one day. So thanks to Northwestern Mutual, Babcock Financial. I appreciate you guys coming in, and have a great day. Thank you, guys.
Thank you,
Dan.
guys.
Thank you,
and,
Chandler.
and on behalf of the many clients and colleagues that we've sent you over the years who you've assisted through some of the largest transactions they'll ever do in their lives, we thank you.
Yeah.
You guys have been fantastic for our people.
Absolutely.
Thank you.
Appreciate it, guys. Have a good day.